Hello and welcome to lesson 3 of the course. This is the day trading course. And if you hear an echo, that's because I'm currently in a new apartment and, actually lesson 5 of the day trading course. So if you hear an echo, that's because I'm actually in a new apartment and there is no furniture I've moved in yet. Right, so I've ordered them and they're still coming. So it's really just an empty room with my bed. And so that's what just an echo. All right, so today we're going to talk about the central bank deals range and the flow. It's a real straightforward concept, and this really applies to currencies. Okay, so I'll describe what the central bank deals range is. In case you're wondering, what is the central bank deals range? Well, I'm going to type this out for you. The central bank deals range is what we call for short the CBDR. Okay, so we have a central bank dealer's range. All right, and then for short is what we call a CBDR. Essentially, what a central bank dealer's range is. Now, in or on lesson 3 of the day trading course, where I talked about the daily candle, I dropped a PDF, which is what you can see here. I did actually drop a PDF of the time windows for each time window for the data range or in the data range. Now you're gonna see this is the PDF here. Actually, you're gonna see that we have a period in time after an year close, which is the central bank dealers range. Now, if you notice classically, there's a very specific period almost every single day where the market just goes into a very tight consolidation. Like the market's not really doing anything. Right, the market just goes into a very, very, very small range before Asian session, and then it starts to see a little bit of, let's say, small volatility in price. That dead period in time is what we call the central bank tilts range. Now, during this time, classically, like basic forex understanding, we know not to trade in this period of time because it is very low probability due to the lack of volatility around the time window, because there's no important time window or just no important session around that period of the day, right? It's outside Tokyo session or Asia. It is outside London session or European session. It is also outside the North American session, and that classically is when the North American banks are closing or they're closing up shop for the day, which is 2 p.m. Eastern. Right, so between that 2 p.m. Eastern to 8 p.m. Eastern, there really is not a ton of activity at the interbank level. So the volatility in price is usually very, very small and fickle. Now, that period in time, which is specifically the 2 p.m. time window to the 8 p.m. time window, now this is all on Eastern Standard Time. So between 2 p.m. Eastern Standard Time to 8 p.m. Eastern Standard Time, we have the dead period in price, and usually the market will go into very small consolidation. And this understanding of this time period can be utilized in understanding how the range for the daily candle should be set. We can use that actually forecast to a very insane level of precision. We can use the forecast the daily highs and lows. And I know it sounds like it's not possible to forecast daily highs and lows, and it's not something I usually talk about, nor is it something you really see me do on a live session because it's not that important for your own profitability in trading. Now, again, you need the other elements for you to be a profitable trader. But if you need that next level of precision, or if you need, especially for those of you guys who are day trading or scalping, this is something you want to really employ in your as one of your tools for your day trading model or your scalping model. Okay, it helps you understand where the market is going to, where the market is seeing intraday turning points, and how to anticipate price delivery. Now, let's talk about what the central bank dealers range is. The central bank dealers range, which is the CBDR, is a time window between 2 p.m. Eastern to 8 p.m. Eastern, and this is the dead period where there's no main active sessions in the daily range. The algo typically will use the overnight ranges to set the high of the day and low of the day usually. So this is classic price action. The characteristic you're looking for to utilize the ranges is you're looking for a very small tight consolidation. Preferably, I like to see relatively, and this is for the majors. You can also apply to the crosses. Now, obviously, if you're using the crosses, you have to be more lenient with your pip ranges. But classically for the majors, I like to see 20 to 30 pips, right? 20 pips of range is what I like to see. And what I'm looking for specifically is I'm not looking for any kind of volatility in the price. I want to see the market go into a very small tight consolidation, not neither moving higher or lower, just a small little range. And that gives me insight into how the algo will price in liquidity for the day. Now, the understanding of the central bank dealer range stems from our understanding that price is not delivered on the basis of demand or supply. We understand that price is delivered algorithmically. It is all artificially driven. It is all artificial. It is all artificial pricing. So we can pre-anticipate how the daily range should form or set utilizing the central bank dealer's range. Now, how you want to utilize the central bank dealer's range is you're going to use that time window we talked about. And again, the time window is from 2 p.m., which is when we have the trade close, to 8 p.m., which is when we have Asian open. So we're going to look for 2 p.m. on our chart here. And this is 2 p.m. here. And this is 8 p.m. here. Okay, so now this is our time window for the quote-unquote dead period in Forex, or what we use as institution traders as our CBDR, which is central bank dealer's range. Now you can see the range here. Look at how small and little the range is. If we do a measurement of the range, you can see it is around 13 pips of price delivery. So we have a very small, nice little consolidation like this. This is what we like to see classically for our dead period. Now, what we do here is inside the range, we go in and we look for the highest high within that time window, and then the lowest low within the time window. Now, what I typically like to do is I like to look for the candlestick bodies and not the wicks. Now, sometimes I might use the wicks, but most of the time I like to use the bodies of the candle, because remember, bodies of the candle is where we have the majority or the bulk of volume or liquidity from an interbank price delivery standpoint. So I'm going in here within time period or window. I'm looking at the highest up close or highest closing candle on the eye, and then the lowest closing candle, and that's my range. Okay, and this is my central bank dealer's range. This is the highest candlestick close here, and then this is the lowest candlestick close here. And that's the range I'm utilizing for my central bank dealer's range. Now let's go into the next topic with this, and this is more of an addition. They go hand in hand together. The central bank dealer's range and the next thing I'm about to talk about. All right, they go hand in hand together, and that is what I call the standard deviations. So I'm going to type this out so you understand what I'm saying, and this is what we'll call standard deviation. Or again, if you want to short it, you can call it SD. Now, what is a standard deviation? A standard deviation simply is a range projection of the central bank dealer's range. And this is how you can project daily highs and lows. So what we're doing here is that during this quote unquote dead period in the foreign exchange market, where there's no major session and market volatility is not high, the market will go into a very small and neat consolidation. Now, the algo will use this consolidation to then project price delivery outside the range. Now, one standard deviation of our central bank dealer's range is simply a 200 extension level from the Fibonacci, or a range measurement, which is, for those of you guys who understand retail terms, you know about the A to B, and then the C to D price delivery, where the market will make a measured move. One standard deviation for the central bank dealer's range is one measured move of the central bank dealer's range. That's one standard deviation. Half standard deviation is half of the measured range of the central bank dealer's range. So we have one standard deviation higher, which is this here. That's a standard deviation higher. and then we have a standard deviation lower. Again, I'm trying to be as precise as possible with the lines. And this is a standard deviation lower. So we have one standard deviation higher, one standard deviation lower. Okay, and simply this is just simply a 200 extension level of the highest up close and the lowest down close here, and also 200 extension level of the highest up close and lowest down close here. So now what you can do to calibrate this, rather than going through the process of taking the range and then using lines to measure, it's really a very long process. So the simplest thing you want to do is you want to go to your Fibonacci settings. All right, click on your Fibonacci settings, draw it out, go to the settings, and then what you want to do is you want to set the levels on your Fibonacci to 1, -1, 2, 3, all right, -4, -3, -2, -5. Okay, and what this actually does with your Fibonacci is -1, right, is one standard deviation lower from the range you're measuring. -2 is 2 standard deviation or 2 range projection measurements lower than the range you're measuring. 2, or just your normal 2, which does not have a negative value, is 2 range measurements above the range you're measuring. So let me show you what that looks like in practice. So now you already know that we took the measurement of the highest up close candle and the lowest down close candle here, and we projected it, and the projection of that range is what we'll call the standard deviation. So again, take note. A range projection of a central bank to this range is what a standard deviation is. One standard deviation is one full range projection of the central bank to this range. And that's this here. Now, rather than going through the entire process of using your trend lines to measure the highest up close candle and then the lowest down close candle, and then using that to project the range, you can just simply go with your Fibonacci and take from the body of the candle to the low of the candle, and you can see one standard deviation is your 2. So that's one of this range on top of the range, that's your 2. Then 2 standard deviation is your 3 extension level. And you can see 1 standard deviation lower is your -1 extension level. 2 standard deviation lower is your -2 extension level. So you don't need to go through the entire process of you having to use a trend line to then draw up the highs and lows and then flipping it on top of the range and then using that to look for your standard deviation levels. All right, so you can just use your Fibonacci to identify the levels. Now we've already done that, and we understand how to use our Fibonacci to define or identify highs and lows in price. Now, again, we already understand what the central bank interest rate is, which is a dead period in time where the algo will create smaller the ranges and then go into Asian session, which sets the tone for the day. The algo will use that to set the highs and low for the day in direction with daily buys or daily price delivery. And we understand that the standard deviations are simply range projections of the central bank dealers range. Now, how can we identify high odd setup? Using our standard deviations, again, because the central bank dealers range is useless without the standard deviation, and that's why I said they go hand in hand together, right? So one cannot function really without the other, right? So if we have a central bank dealers range, then we also need to have the standard deviations for us to be able to utilize them for price delivery. Now, how can we use this concept for our day trading or scalping? Remember, our understanding of price always stems from daily order flow. We need to know where daily deliveries expanding up or down into. Now, I recently had I'm not going to say it was an argument, but it was more of a conversation on Twitter, and I stated that if you are a scalper intraday, you need to have an understanding of the higher time frame price delivery to efficiently scalp intraday. And someone said, no, don't do that. And that's one of the worst advice you could get as a scalper, that you don't need daily order flow. and what you need is just lower type of price delivery. And I think the person was actually thinking that me saying you need daily order flow to scalp means that you're only going to trade in direction of daily order flow. If you're going to trade again for scalping, you can trade against high time frame direction. But if you don't understand what the daily time frame is doing, moves like this will catch you off guard because you're not going to know the reason why the market has been explosive on one side. And that's one of the downfalls of scalpers who think they don't need to understand daily order flow to scalp. Right? If you want to trade both ways, which I'm going to teach you the model to do, you're going to trade both directions and you want to sell and then buy and you want to do all these fancy things, which you've seen me do on Twitter, then you need an understanding of the daily range or daily delivery. Right? Without a very full understanding of daily range or daily deliveries, it is very difficult for you to go into price and looking for how the market should deliver inside the daily range. And usually the market would have explosive move in direction of daily order flow. And if you're caught scalping the other direction when you're not supposed to do so, you're going to pay the price dearly, really, really dearly. So to utilize the concept of standard deviations, you need to blend the standard deviations with your PD array levels after you have a higher time from directional premise. So again, before we go in and do that example for USCHF, the first thing we need to do is we need to go out to a daily time frame and see what price is doing on a daily time frame. So first, we can see again, this is something we talked about on the last video, I think. You can see that the market obviously is bearish. We talked about how as soon as we broke below this major low here, we already had a shift in order flow. We have sales of liquidity here, which is the rejection block down here, which is where the market should ideally reach for as a near-term objective. We've seen the market return back up into a level of high time for premium, which is this daily bearish block here. We're going to anticipate some kind of measured distribution lower or run lower. If we go on a lower time frame delivery, you can see how I'm rushing through the breakdown from the higher time frame standpoint to a lower time frame price delivery. So this is Monday here, this is Tuesday, this is Wednesday, and you can see our valuation by speculation where the market opens up on Monday and starts to aggressively run for a premium array going into Tuesday. We sucks in retail to want to chase the runs higher and then engineer sales liquidity on the downside. So what I've done here is I've gone through the reasoning as to why, or the most likely direction for our daily candle, which is bearish or short. We're looking for sells today. That does not mean we cannot go in and look for a short-term scalp to go long. Well, we understand that daily order flow is bearish, so we should be more cautious looking for longs, and we should be more willing to cut short or longs if we start to see the market not offer the delivery we're looking for into a premium if we're buying at discount, right? And that's all it does. All your daily buys does, it helps you put things into perspective in terms of your intraday scalping, right? So you can see the market runs up into the high time frame premium, which is this fair value gap here. Again, if you take your range measurement from this side all the way down to the lower range, you can see it comes above the equilibrium of the range, which is essentially premium. All right, so the market runs up into a lower time frame premium, which also just happens to coincide with that higher time frame discount or a premium, excuse me. Right, and this is how you can break down your higher time frame premium levels into and refine the levels into lower time frame delivery levels. So inside our daily level, our premium array we can identify is this fair value up there, which the market trades up into. Now let's go into price intraday and see what the market was doing intraday. So first off, let's define our central bank to this range, and it starts here and it ends here. So we'll look for the highest high inside the range, then the lowest low inside the range, and then we'll project. Now this is something I want to talk about. A standard high for the day in a bearish daily order flow or in a bearish daily candle is usually 1 or 2 standard deviations. So this is something when I actually write this down. So what I want you to do, because I don't want to go through tons of examples or multiple examples to communicate the point across. So write down your notepad or your journal and go on backtest this. Look for daily bearishness in price, and then look for bearish candles. Okay, and you're going to see majority of the time the high of the day in a daily bearish candle is usually one standard deviation, or sometimes two standard deviation, but that is most of the time. So I'm gonna say 80% of the time it will fall around one or two standard deviation. Okay, because the market does not need to really expand higher to then sell off, because our order flow direction is on the bearish side. So we're gonna see more delivery on the bearish side versus on the bullish side. So any run higher, again, remember with daily candle understanding, any run higher is simply a run up for bearish accumulation, right? So we're running higher to accumulate sell orders and then deliver sell orders into an available pool of liquidity on the sell side. So you're going to see more expansion on the sell side versus the buy side. And you can see the speed of delivery here higher, right? As we're running higher into premium, it's not really that fast. It is more slow, lethargic. But every time you see the market try to trade lower, look at the speed it does with in terms of delivering prices lower. Because the run lower is in sync with daily order flow. And then as we run higher again and clear our sell stop, look at the speed of delivery lower, right? It's not the same as the run higher, which is a little bit choppy and not as fast or one-sided as run lower. All right, so you can see here, if we take our range for our central bank interest range and we project it higher, one standard deviation is this line here. So this is one standard deviation. Okay, now we have one standard deviation there. We're gonna make it a dashed line. And what does that coincide with? What premium array can we see around our one standard deviation? First up, we have our daily bearish order block, and then just above the daily bearish order block, what do we have there? We have a fair value gap. Now, going into the start of New York session here, this is what starts New York session. This specific day, right? If you go through the evening commentary, I told you to wait until for your day trades. Wait until close to the 3 p.m. or the 10 a.m., which is London close speech for your executions, because the market was more likely to hold in a range prior to the numbers release at 10 a.m. So this is Wednesday, 21st of June. So let's go to the economic calendar and look for 21st of June on Wednesday and see. You can see we had a numbers release on Wednesday, and then which is London close at 10 a.m. And for New York session, we only had a major impact on Canadian dollar, which was core retail sales numbers. Just core retail sales numbers, which is the only economic release we had for Wednesday on Canadian dollar. Right, so the main economic release, and again, I've taught you how you can utilize the economic calendar to time price delivery for the day. Okay, so we understand that the high impact release is for London close. So we know that towards the last 30 minutes of New York session, heading into London close, is where we'll start to see the market really start delivery, especially if we see a lack of delivery during London session and New York. Now, what is the market profile of that 3 p.m. number? Okay, so this is the 3 p.m. numbers here. Okay, this is the time where the news release is coming out. No, I keep saying 3 p.m. That's my time zone. That is actually 10 a.m. All right, so this is the time window for the 10 a.m. numbers. Now, what is the profile heading into that 10 a.m. number? Are we seeing any delivery lower? Of course not. Are we seeing any delivery higher? Of course not. So what's the market profile? Consolidation, right? That's going back into lesson 3 of the day trading course. How to profile the market and use the market profile to aid in your understanding of price in line with high time frame order flow. So what you can see here is I broke down high time frame delivery into lower time frame, that's a 1 hour price delivery, and then a lower time frame delivery. Now, if we're looking for weakness in price, where do we have the next available drum liquidity to aim for? We have very clean lows down here. You can see how this low is here and this low is here. So any retail who is going long, they're trading your stops here and then here. Look at this. We have this low and this low and this low and this low. So there are multiple lows there that a lot of traders will consider support. So if we see the market break below this low here, most likely they're going to have protected stops resting down here. So we can aim for this low here, and we can also aim for this low down here as sell-side liquidity objective for intraday price delivery. Now going back, you can see this dashed line there, that's one standard deviation of the central bank tilts range. During London session, see how precisely and perfectly the algo runs up into that high after running out the highs from Asia, and then starts the first silver cycle lower. Then going into the middle of London session, the market goes into consolidation, going into London lunch, which I talked about, classic London lunch price delivery. The market was staying in consolidation. And then at the start of the New York session, we start to see a delivery cycle higher. But notice the market is not making any higher highs in price or lower lows in price. It is staying within the range formed during London session. So our market profile is a range or a consolidation market profile. Now, again, I mentioned that you want to wait until very close to the numbers release or the speech. So this is a speech, not a numbers release. So whenever you see testifying or speaking, that's a speech. All right, so you want to wait until very close to the speech to do any engagement with the majors, especially USD, Euro, Pound. And you can see very close to the speech, we start to see a sudden run higher. That's weird. Our bias is bearish on the daily time frame. What does that mean with that sudden run higher? Is that a run for stops? Okay, the market has run higher and taken up buy stops here. Now, what do you think retail is doing at this point? You can see a low here. We have another low here, another one here. Isn't this retail support? That's retail support, right? I'm seeing the market run above a short-term high into this bearish shuttle block. Now, retail will look at this as the breakout looking for longs. But if we compare this high with, let's say, a correlated asset, and let's use treasuries. If USDCHF is running higher, okay, we do not want to see treasuries do what? If dollar is going to go lower, we want to see treasuries run higher. We want to see treasuries be bullish. So as we are running higher on USDCHF, remember the base currency is dollar, and then the core currency is Swiss franc. So if we're looking for lower prices in USDCHF, treasuries should be doing what? Should they be going higher or lower? They should be going higher, right? Because a high treasuries means a lower dollar. And if we're looking for lower dollar, that means consequentially that USDCHF should be weaker. So as USDCHF runs higher, we can see the 30-year treasuries also run lower, either of the numbers release. Okay, so that means this run higher on USDCHF means that we're now bullish in USDCHF because 30-year treasuries says it's weaker, right? So weaker treasuries will now allow for a weaker dollar. All right, so that is the 30-year treasuries. Let's see what the 10-year treasuries is seeing in terms of price delivery. Is the 10-year treasury confirming the same sentiment? Oh, I think I messed this up. Okay, let's go back to our chart annotation. That is this one here. And I was supposed to drop the comparison tool and not switch chart over. Okay, so let's see what the 10-year treasury is seeing. So we're going to compare against the 10-year treasuries and see if they actually confirm that run higher with USDCHF. Okay, so as we start to run higher on USDCHF, what is treasuries doing? It's also running lower. 10 treasuries run lower. So that means it's run higher in USDCHF. Shouldn't that mean that it is now bullish? Since we're seeing 10-year treasuries run higher, 30-year treasuries run higher, or sorry, run lower. We're seeing both of the treasuries market run lower. Now let's see what the 5-year treasuries is doing as we're running higher with USDCHF. It's not failing to run lower like we saw with the 30-year treasuries and the 10-year treasuries. It is making a equal lows in price. Okay, so it's not going lower the lows are equal. Now, if you compare that to the 30-year and the 10-year treasuries, you see they were both running lower. If we are seeing the 10-year treasuries and 30-year treasuries run lower, that should be confirmed with the 5-year treasuries seeing lower prices, but it's not. Instead, we're seeing the 5-year treasuries see equal lows, not showing a willingness to run lower. Okay, now obviously if you go and you can use a curly pair and use dollar for example, and if you're seeing USHF run higher and take out buy stop, then you want to also see dollar uh, either fail to confirm the run higher or stay in a consolidation. Okay, and what you can see here with dollar is actually dollar is trading in sync with USCHF. So it looks like we're now at this one here. We thought for a displacement lower. It looks like we're broken higher, we're broken structure higher. But now the key here, and this is why I pulled up the interest rate market first off. And I did a video recently, which I dropped yesterday, and the video was on confirming runs and stops, or confirming stop runs versus confirming breaking structure. And now you can use the interest rate market to confirm if a run is a run and stop, or if that run is simply a breaking structure. And you can see here that run higher on USCHF was not being confirmed with the treasuries market, because if we're seeing 30-year treasuries run lower, and we're also seeing 10-year treasuries run lower because we're expecting lower price in USCHF, that should also we're expecting higher price in USCHF. That should also be confirmed with lower prices on the 5-year treasuries, but it's not, okay? And our original bias was looking for weakness on USCHF, meaning we want to see strength on the treasury. So we're looking for reasons why strength should come into the treasury to allow for weaker prices on dollar, which would then transfer into weaker prices on USCHF. And you saw that with the divergence at the lows amongst the three key treasuries assets, which is 30-year treasuries, 10-year treasuries, and then the 5-year treasuries. Remember, 30-year treasury is a measure of longer term treasury prices, 10-year treasury is a measure of intermediate term treasury prices, and then the 5-year treasury is a measure of the short term treasury prices. They always trade in sync, but around key turning points, you would get a S&T divergence amongst the three, which is what we identified as we saw USCHF run up into our 1 standard deviation coupled with our 1 hour fair value gap at premium. And then look at what the market does next. Runs lower or breaks structure lower, and the structure lower is this low here. Market runs below structure lower. We have a small little fair value gap with a breaker block. Short to mine, runs higher, displaces lower. Breaker plus fair value gap, that's a sell at. This is the numbers release, the 10 AM numbers release is this line here, and that's when the algo kicks into delivery. And you can see how the eye of the day forms around 1 standard deviation higher from the central bank deals range. Now let's talk about nailing the opposing end of the daily range. Okay, in a classic trending environment where we see large ranges, the opposing end of the daily range will usually be 4 to 5 standard deviations. That's classic price delivery for large ranges. Very rarely have I seen 8 or 7 standard deviations. Classically, for a large range, it usually is 4 to 5 standard deviation. Again, remember, for a high odd anticipation of your highs and lows with these standard deviations, it also has to be coupled with a PD array. So what PD array can we see if we pulled up our standard deviation and we did our range measurement? What PD array can we see as an objective draw on liquidity for USCHF, looking for weakness? You can see below the short-term low, we have 2 standard deviations. Rather than aiming for the short-term low, we can use 2 standard deviations here. And then below this low here, which is what we're ultimately aiming for, we have 4 standard deviations. So we can use that there. Now remember, in a large range day, classically, the market will see the low of the day. For bearish order flow, it will see the low of the day form at -4 standard deviations of the central bank to this range. for a large range day or a large bearish candle. For a large range day for bullishness or in a daily bullish order flow, the market will see the high of the day form around positive 5 standard deviations of the central bank Dillis range, or sorry, positive 4 standard deviations of the central bank Dillis range. So that essentially means 4 multiples of the range of the central bank Dillis range is where the high of the day would form for a large range day. Okay, and then for the high of the day for a bearish or anticipated bearish daily candle, the high of the day should usually would form around 1 or 2 standard deviation. Beginning, you have to blend it with a PDR rate. Okay, so if this is what we're aiming for, and our 4 standard deviations here, you can see at the 4 standard deviation we have an institution number right there that is 0.8930. Okay, 0.8930 is our institution number right there. Now, what I want to draw attention to is what institution number can you see below the slope here? If you took your line to the slope down here, what's the nearest institution number there? The 50 level, the mid-figure level, right? And what have I taught you with the mid-figure level? Usually with mid-figure levels, the market will run them in 20 pips. Okay, for the round figure numbers or daily levels, that's where the market will run them usually with 30 pips or sometimes as far as 40 pips. But for the mid-figure numbers, it usually is a 20 pip run or sweep of liquidity on them. Now we have a confluence of multiple PDR rates. We have our 0.8930 level. We have a 20 pip sweep. So 20 pips below the mid-figure number is 0.8930. That also aligns with this old low here, these green lows here that started all the run higher. And then that also aligns with our 4 standard deviations. So we have a very strong likelihood that the low today is going to form around, or is going to form at 0.8930 level. And let's see what the market does next. At 0.8930, you can see that is around where the market forms the low of the day. And then if I did this again just one more time, and here, and I squish this lower, and at 5 standard deviations is where our final delivery comes in at. Okay, so 4 standard deviations, that's where I will scale out the bulk of my profits because it is below this low here. And then at 5 standard deviations, which is 30 pip run, that's a 30 pip run below the mid-figure number. That's where we see the actual of the day come in at. Okay, which is here, and that is right around the start of our central bank Dillis range before the market goes into consolidation. So this is how you can utilize CBDR in range projection for highs and lows of the daily range, and using the standard deviations and blending them with PDR rates and understanding of daily order flow to frame day trades and also scalps, and also use the economic calendar. We're going to do more of this. We're going to do supplementary videos with this, but on the next lesson, I'm going to go through the flout and how to utilize standard deviations with the flout for your daily range, and also when to utilize standard deviations, utilizing the flout for projecting daily highs and lows. So I'll catch you in the next video, and safe trading.